The tensions are still heating up. Clearly, investors are not waiting for resolution. Many individuals and businesses have been selling off U.S. assets. But of course, this isn't directly related to the trade issues, but it is compounded through uncertainty. Countless economic indicators have piled up, showing that China's slowdown is still continuing despite the rhetoric that everything is doing just fine. Go back to sleep, my little sheep. You came here for the truth, so let me unveil that for you. Today we're going to have our focus on China. I just did a video previous to this talking about China, talking about the issues there. I had so much more data. I wanted to cover it today. We're going to look at a few aspects, one being real estate, then we get into the investing side and we look at the economic indicators. Beyond that, I have a lot to cover, so let's begin by taking a look at this. Out of the Wall Street Journal, Chinese exiting U.S. real estate as Beijing directs money back to shore up economy. So we're looking at this right now from a couple days ago. Chinese purchases of U.S. real estate last year dwindled to the lowest level since 2012 as Beijing kept up the pressure on Chinese investors to bring cash home during a period of worsening economic growth. So they have the power to do this somewhat. Of course, we see that there are always ways around. There are loopholes, but for the most part, they can encourage this behavior. And it looks like there was a significant change. Insurers, conglomerates, and other investors from mainland China were net sellers of $854 million of U.S. commercial real estate. And think about that. That's nearly $1 trillion worth. And of course, that does make a big difference. That's in a quarter. We're not talking about a long period of time. You have to understand what has happened. All of this comes at a time when the trade issues right now are at a stalemate. They're at a standstill. I personally believe that there will be at least some level of token resolution, and they can go in both of their sides, both the media, and say, we won, and it may not necessarily be a resolution to any degree, but they want to be able to show their own sides that, look, we won, so it looks good for the economy, looks good for the markets, and so on. This is just one aspect. And then we get into this issue. Looking at this, Chinese investors are beginning to retreat from U.S. commercial real estate, but don't think that they are staging any fire sales. These investors, who were among the most aggressive in the U.S. market, have become net sellers to repay debt, to offset losses, or under pressure from the Chinese government to curtail overseas investments. So we have to go deeper into the issues and understand why this is happening. Of course, this is only one view, but it's interesting to say the least. In most cases, they've been able to profit when selling because the U.S. economy is still going strong and prices in commercial real estate market holding steady, though some Chinese sellers may have barely made their money back. This is the issue with commercial real estate and why typically it's much more difficult to get into the real estate in the commercial side versus residential. For those who can afford it, when you go into multifamily property, it becomes much more advantageous to do so because you have the knowledge that there's probably always going to be somebody that needs to live in that area if the fundamentals persist. The fundamentals must persist. With commercial real estate, you add another level of complexity, which you need to really be astute. You need to really understand your market much better, even more so than in the residential side. But that's besides the point. Let's go into this report. Most of this, I believe, is out at Credit Suisse, and they produced this report. It had a lot of details about what's happening right now from 2018, even brand new data that we're looking at here. So I wanted to show that to you. Several of these have been coming from that report, but this one here and another I'll show you are just some data that I pulled up as well. This happens to be the manufacturing indexes. As you can see, all throughout 2018, these have been declining, and manufacturing is so important for China. Obviously, they are a major exporting nation, and you can see that this has been really a hindrance upon them, upon their economy. As time goes on, it's not going to get any better unless we see resolution with the trade issues, unless we see a weakening of the US dollar. I'm sure this is all having an impact because they are now seeing some changes and not in a positive way. So whether we're looking at any of these different types of manufacturing indexes, I think it's important to focus on the general trend. The left-hand chart is talking about the average mortgage rate remaining very high compared to the rental yields. Mortgage rate being the gray line and the blue line is the rental yields. And it's just interesting to see that specifically. On the right-hand side, house prices in China's major cities are among the most expensive in the world. And I wanted to focus on this. We're looking at the price to income ratio. And to give you an idea, the very, very bottom of this list is New York. And New York is excessively expensive. And you're not just talking about dollar terms. We're not talking about that. We're talking about price to income. So what the average person's making there and what the average home costs, okay? And then when you look at that, it really compares it. It makes a lot more sense to me than simply a number. Because if you take somewhere in the middle of the United States, for example, who lives in an area that's very rural, well, the average home might cost $200,000, but their salary might correspond to that. You take it, for example, San Francisco or New York, and you see a very different picture. You see that housing prices are excessively expensive, but their wages are also higher. However, we find that where the housing prices do get higher, that this divergence really grows big time. And this happens to be one chart that really shows us this on a global level. Now, there are always the case every single time I see this comment that New York, for example, doesn't represent all of the United States, or Tokyo doesn't represent all of Japan. And I'm quite aware of that. All right, it's pretty obvious. But you have to look at the most populous cities. That's where most of the population is. So that's where you have to focus on. When we look at places like I just did with Sydney, and you see Australia as a result, you take those most populous cities and be able to form some level of judgment. You can't generalize to a great degree, but you have to when you're trying to come up with some level of consensus here. Anyway, back to my point, price to income, we're looking at places like New York, Paris, Rome, even Brazil in here. You're seeing London in here, right in this part of the list, much more expensive in terms of price to income than New York. You go along with that and you start to see these Chinese cities right here, whether we're looking at all these in the gray or even Hong Kong at the top of the list. It is insane. The highest on this list, and there is no possible way that the average person is able to afford a place. There's just not a possible solution to this. They can't do anything to make it more reasonably expensive for people by, let's say, giving them money every month or letting them use some sort of tax credit. It's far beyond that, okay? So this is a nation of renters that has been found here. And that's not necessarily a bad thing. In many places around the world, renting is just very common. It's what people do. However, we need to start asking ourselves, who do these assets being priced at this level really benefit? If your home today is worth $1 million and you're sitting on it, and let's say either way, if it's actually paid off or the bank actually owns it and you just live in it for 30 years, either way, what we're looking at right now doesn't necessarily do anything for a person. It's just equity. It's sitting there. Yes, you could factor in, yes, this is money I have. It's like a bank account, but hopefully you wouldn't touch it. So you're sitting on it and doing nothing with it. Currency is really only valid to you when it remains in motion, when it's being invested. And if it's just sitting in equity in a home, it's not necessarily benefiting you. I understand the security aspect, but it doesn't provide anything for you. So wouldn't it make more sense to have these assets like real estate be priced at a semi-realistic level? Well, of course not. That's ridiculous. That's what most people say anyway. They feel very rich when their homes go up in price. Many people are using their home as an ATM. They've been doing so for quite a while and it's only getting worse, but that remains to be part of a issue in the future. Property transactions versus house price inflation implies a fall in house prices from here. I'm not saying that. That's just the trend. When you look at China's property transactions, you could see the decline. from 2015 up until present, on average, it's been declining. And the house price inflation, while it has moved up, this tends to be an indicator that we will see a decline in that. So we're going to look at this and see what happens with the prices. They have seen massive stagnation in Hong Kong right now. However, as I mentioned just previous, the prices are extremely high. They need to come down very, very much as far as I'm concerned. Second home and third home buys is at a record proportion of home buys. You can see that as the years go on, they're purchasing more second and third homes right now in China. This data actually goes back into the first quarter of 2018, but it's very valid today. Property developers have recently started to underperform and tend to lead housing turnover. Very interesting to me because you can see the black line is the MSCI China real estate relative, and that had been increasing. And just underneath that, you can see the property transactions, which will in fact have to track and trace the behavior of this. So we'll see how time moves these markets. On the left-hand side, consumer share of GDP in China remains very low. I thought this was interesting. You can compare all these different countries right here. On the left-hand side, you have your percentages, which is basically the current consumption share of GDP difference to the 20-year average, just to give us an idea. And on the bottom is the current consumption share of the GDP. You look at a place like China, and it shows us that there is a lot more that they can grow in terms of their consumer side. It's not like the US, which is above, it's in the positive, and that right there shows us how dependent the US economy is on the US consumer. There are several other countries in here if you're interested on checking that out. On the right hand side, household debt is increasing rapidly. A problem possibly related to what we're seeing with real estate. It's too expensive. They're taking on too much debt, but also they're buying other things. They are consuming more and more. As I just showed you, the second and third homes are an issue. That isn't necessarily a good thing as far as I'm concerned. Buying assets and not understanding how to invest is not wise. You need to know, you need to do your due diligence prior. You can't just buy something and expect that it will always rise. That is very foolish. I'm not necessarily suggesting that anybody who bought real estate is in trouble by any means. I'm just suggesting that people who are not sophisticated are doing so, then they get burned and then they suffer. Growth of income available to spend dropped sharply. So you can see the red line, disposable income net of debt service, and that has declined right now through the years. The chart goes from the year 2014 up until the end of 2018. So I wanted to make note of this. When China GDP growth slows, import growth slows by much more. Another interesting one here, China's imports from Germany, that's the gray line, and you have the black line, which is China's nominal GDP growth year over year. They seem to be in lockstep. This is from the financial crisis up until late in 2018. Very clear to me. We'll see what they do because obviously when they're importing, we know specifically that we can get an idea of what's happening. Are they importing all those goods used for construction? Is it for domestic consumption? What exactly are they up to? What about their currency right now? How has it been over the last few months? You need to understand when they're doing trade, what currency they're buying it in. They have to buy with US dollar. They're converting that currency. They're losing a lot of money. It hurts them. Is that what they're doing? Are they finding a new partner? And so on. Lots to think about. The last time China had real GDP growth of less than 5% was in 1990. The last recession was in 1976 when we saw a 3% contraction in real GDP, just showing us here that real GDP continues to decline. That's very, very important to address what has happened in China today. They're saying it's over 6%. However, we need to really come to our senses in reality. Aggregate demand growth is close to the weakest on record. Take a look at this chart. I mean, you can see what has happened since basically what we had here was the year 2000. It rises like crazy, and then there is a major contraction towards the financial crisis, but that continued its trend on the way up very rapidly, I must suggest to you. And then it didn't take long before the stimulus wears off and you can see that demand really sliding down. Always looking at all of the indicators is so important, and one of them being the Baltic Dry Index. This is one that I always like to keep an eye on. It fluctuates. You can look at it year to year. You can try to take it for what it is, because remember, although it's important, it's only one indicator. However, just look at the end of the year, what has happened from the beginning of October up until the present. It has been a serious decline. The second half of 2018 up until 2019 has not looked good in this regard. The tensions are heating up. The economies around the world are slowing down everywhere, from China all the way through Europe. Even Germany is looking like potentially entering into a recession, but we'll see what happens. It's getting very slow. Italy's already in a recession. The US, despite the fact that many people are not willing to admit it because everything's so wonderful now, that it isn't looking good. There's a lot to check out in here. I'm going to end the video. Just wanted to give you some more facts about what's happening in China today, keeping you updated. So I hope you appreciated that. If you did, just give me a thumbs up. If you want to support this channel, you're unsure how to do so, give me a thumbs up and comment on the videos. This really helps me out a lot. There are, let's say on average, probably about less than 10% of people that give me the thumbs up. So if you could do so, that really helps to support me. Even if you're not going to watch the video, you just come in, give me a thumbs up. I really do appreciate that. Thank you. And last but not least, if you want the financial education you were not taught in school, these two books are everything that you need to know. When you take a look at them, you will be able to see how easily and simple I have broken down all of this data that is truly made to be complex intentionally. So I break that all apart in these two. Check them out. Link is in the description. If you want the audiobook, you can get that at themoneygps.com.